Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa. If you find this video helpful, please press the like button and don't forget to subscribe to see our upcoming market reviews.
Good day and welcome. I am Nick from the Overberg Greyton office. We are glad that you can join us. Today we are looking at the developments globally, if there have been any changes and how they might influence the markets. The Fed minutes came out and they were incredibly hawkish. We're going to have a 50 basis point rate hike. Also, the quantitative tightening will begin in May, probably to the tune of $100 billion per month. So we've never had this before. In the past, when we've had quantitative tightening, it's just been a runoff of maturing bonds, whereas this time the Federal Reserve is actively going to be selling bonds into the market. So typically across the portfolios, we have about 23, 24 different holdings. In the first quarter, 10 of those holdings produced positive returns. So it's really good that we've had so many positive gainers in a very weak market environment. Kicking off then with the Institute of International Monetary Research. They say that double-digit annual rates of inflation now seem certain in the US and also likely in the Eurozone and the United Kingdom. The oil fallout, particularly bad for Europe, I suppose. The European Commission plans now to reduce its reliance on Russian gas by 2/3 this year. Europe looks set to continue its efforts to write Russia out of its energy mix, regardless of the outcome of the war. And this is from Capital Economics. This, of course, will prolong the squeeze on household incomes in Europe. How does it compare with the 1973 oil price shock? A key similarity between then and now is that there doesn't appear to be sufficient supply elsewhere to make up for the shortfall. Another parallel is that in 1973, the US responded to the sudden loss of OPEC supply by accelerating efforts towards energy independence. I suppose what's a little bit worrying is the key difference. Perhaps most notably, whereas the OPEC supply was only held off in the early 70s for 6 months, Russian supply today seems unlikely to return anytime soon. And how does it affect the economy? Still Capital Economics here. The ECB recently estimated that a 10% reduction in gas usage would reduce the Eurozone output, i.e. GDP, by about 0.7%. So if they lose all Russian gas, it could be devastating for the European economy. Meanwhile, higher for longer inflation will also lead the ECB to start to raise interest rates sooner than we previously anticipated. We now forecast 3 25 basis point rate hikes this year, which would lift the deposit rate out of negative territory and to 0.25% positive by the end of 2022, and 5 more in 2023 to 1.5%. So a typical stagflation grip, slowing growth, rising inflation, rising interest rates. So an interesting piece still from Capital Economics is the effect of these rising oil prices across different economies around the world. They forecast a transfer of income from economies that are net consumers of oil to those that are net producers, which is equivalent to 1.1% of global GDP. The biggest losers will be India and Southeast Asia, along with some of the Eurozone economies. The US should be relatively little affected, explaining why the US market's done quite well over the past month. Japan will suffer moderate losses. In those countries that are net losers, the costs are likely to manifest themselves primarily in a higher path of inflation. And this is the scary bit as it relates to monetary policy. The usual response of central banks is to look through inflation shocks caused by energy. This time, however, the high starting point for inflation and the fear that inflation expectations may become permanently dislodged at a high level add to the reasons for central banks to tighten policy. We expect policy interest rates to rise to around 3% in the US, 2% in the UK, 1.5% in the Eurozone by the end of next year. From MRB, the seemingly bearish signal from tight spreads and a mild inversion in the belly and long end of the yield curve is misleading, since there are currently several distortions helping anchor Treasury yields. We would not read too much into the economic warnings provided by the yield curve, which are at best very early, if not false signals. It typically proves costly for investors to reposition defensively upon the initial inversion of the curve. The broadening economic boom and unprecedentedly strong labour demand is inconsistent with an increasing risk of recession, and this is specifically to do with the States. It is rare that much aggregate damage could occur to the economy until policy rates and bond yields have risen to at least the neutral rate, i.e. when real interest rates rise to at least longer-term real economic growth. And what is that real economic growth? According to MRB, it's around 3.5%. So in other words, the real rate would have to increase at least to 3.5%. Policy rates are currently nowhere near the neutral policy rate. And a crucial point for investment strategy, US stock prices continue to experience a median rise of 13% in the 9 months following the initial inversion of the 1 to 10-year curve. And this segment has not even yet inverted. It means that it would be inappropriate to shift to a defensive investment strategy anytime soon. So that's quite bullish. A less bullish, maybe more forward-looking outlook from T.S. Lombard. They say that the last time the nominal curve flattened, which is what's happened, and nominal yields rose, but real yields did not, was in 1978. The inverted nominal curve did slow growth in 1978, along with the OPEC II crisis, but the slowdown was insufficient to slow inflation. In came Paul Volcker, the famous Federal Reserve governor who fought inflation. Up went rates. I think they went to 15 or 20% in the early 1980s. And his first round of increases, even then, was still not enough. Like Paul Volcker, but maybe to a far lesser extent, Powell is going to have to work hard to drive up real yields. Quantitative tightening, shrinking the balance sheet, is how it will have to be executed. On the US economy, we had very strong non-farm payroll data. So in the month of March, 450,000 new jobs created, and T.S. Lombard make the observation that the March employment report underscores the strong economy, the demand for labor, continued nominal growth in retail spending, upward pressure on wages. They forecast second quarter GDP of 1.5% quarter on quarter, the same as in Q1, or the same as they're forecasting in Q1. What do MRB have to say about the US economy? In terms of monetary policy, they're expecting 2 50 basis point rate hikes followed by 4 25 basis point rate hikes during the course of this year. That'll be an increase in the Fed funds rate of 2%. Some comments from Jay Powell, the Federal Reserve Governor. Powell acknowledges that there is far less certainty about the effect of quantitative tightening on financial conditions, given the policy's very limited history. The rollout of these policies may spark some financial market volatility. So it's not looking so encouraging in Europe as it is in the States. T.S. Lombard talks about a triple stagflationary whammy against the European economy. March inflation, first of all, 7.5% for the EA aggregate, 7.6% in Germany, 9.8% in Spain. Second, the combination of spiking inflation and gloomy war-related news flow has crushed consumer confidence and business expectations. Moreover, the risk of a cut-off of Russian gas supplies at some point is still a possibility. Gas and electricity prices are likely to rise further over the summer. And then third of all, the China slowdown is intensifying amid new large-scale lockdowns. And the largest capital goods exporter to China, of course, is Europe, and particularly Germany. So they stand to lose out from any slowdown in Chinese demand. All right, Gielie, I think the local market is far more cheerful. So over to you.
Hi, Nick. Yeah, thank you very much for the comprehensive macro overview. On the local side, Anglo-American, they unbundled their coal assets into a company called Thungela, and Thungela has advised shareholders that Anglo-American have disposed of the last lot of their coal. It's about 7% of the equity stake in the company, such that at the moment Anglo-American holds no more coal assets at all. They hold no more shares in Thungela at all. Then Moody's ratings surprised us all on Friday evening when they upgraded the outlook for South Africa, our credit rating. They are more positive at the moment, and they changed the outlook for us to stable. We were negative. And the reason for that, they say, that's what Moody's say, is the better commodity prices. And this is really good news. Another bit of good news is that the state of disaster was lifted on Monday night by the president. Another piece of good news is that the fuel levy is to decline by R1.50 per litre for the next 2 months. Also a good thing, it makes petrol a bit cheaper. And then the net investments, they announced that last week they repurchased their own shares on the JSE. They repurchased 200,000 shares, and the consideration was 66 billion rand, and the average price was R3.19 per share. Charts are out for March. Vehicle sales, we sold in total 50,000 vehicles in March. If you break it down to per day, it's about 2,000 vehicles per day that were sold, and that is up by 16% over last year. Vehicle exports dropped a bit. It dropped 12% year over year. The best seller in South Africa by far at the moment is still Toyota. And Toyota said they didn't expect these good sales. They said the sales volumes were monstrous. They sold no less than 500 cars every single day of the month. And they were up from the previous month on month, they were up 10%. But Motors did even better. They didn't sell so many cars. They sold 8,500 cars, but they were up 21% on the previous month. The luxury cars, if you're interested, 1 Bentley was sold, which is not a lot. They normally sell about 3 to 5 Bentleys a month. Ferraris, 11 were sold, which is a high number. Normally it's about 6. Lamborghini, 6 were sold, that's normal. Maserati don't supply figures. And Porsche sold 157 cars. That's what they normally sell, about 150 cars per month.